Time now to say hello to Kenneth Andrade, founder and CIO with the Old Bridge. And I have always said that, look, old but little master is what I would call him, because he's specialized in investing in small and mid-cap stocks. Last time when we spoke to him, he said that buy, but don't buy small and mid-cap stocks, but start buying. And this was the conversation I think we had in March, before the tariff really was at play. So what is your take on the market as where we stand? Will all the tariff, yes, no, I don't know talk?
So going into all of this uncertainty, I think first thing first, we come out in a better place, right? If you look at the Indian context in the international market, we're still extremely small. Even from a global GDP context, we're about 3.5% of world GDP. Now the argument is, can we move from 3.5% of world GDP market share to 5%, and that's where the opportunity actually lies. So a lot of companies that come out of India are now the lowest cost producers, right? And I think we will fit in that space in terms of acquiring market share. So from a perspective of what's happening across the globe, I think everyone will be right that the globe in terms of economic growth will slow down. Now that's a good thing and a bad thing. Okay, the bad parts everyone knows. Now let's look at the good part of the entire cycle and how I think our investment framework fits into that. The good part of that cycle is every slowdown throws out an enormous amount of cash, right? So if you have 24% of the world economy, which is about $26 trillion, actually slowing down, okay, the inventory liquidation in that world economy will create a marketplace or create an economy with a lot of cash. Now there's an inventory transfer that is happening. The inventory holding which was with the US is now gone to the East. The manufacturers.
We're talking about what inventory? When you say inventory, what do you mean by that?
So take any retailing model that is there, take any inventory-led model that is there, car production, garmenting, retail stores, pharmaceutical distribution, electronics, etc.
So for example, Walmart is a superstore and they've been holding on to inventory.
Perfect.
Whether it is cars, I mean, they don't own cars, but
Sure.
you know, everything what Walmart does.
Sure.
The slowdown would come and that inventory will go to some other country.
Perfect. They'll cut down on inventory simply because if prices are going up because of the tariff regime, which they already marked up, everyone will rush to buy cost of products which is low.
Okay, but if US is the biggest consumer in the world, surely because of size and the balance sheet appetite, if the largest consumer in the world slows down, won't that impact the world first before the inventory adjustment happens?
Effectively, that's exactly what I'm saying.
Okay. So what's the part two now? Now that you
So
identified the problem.
The first part of it is you get inventory liquidation, you get cash flow generation in the world's largest economy.
Okay.
The second part is where the slowdown will actually take place. The suppliers of the products.
So China.
Everything. I mean, everything from in the East, China, Cambodia, Vietnam, India, any country with a large trade deficit is going to have a problem.
Okay.
So in this investment environment, if you have to look at a macro picture, any country with a trade surplus has a problem. Everyone with a trade deficit doesn't have a problem.
So India has a trade deficit with US.
I mean, that's where we stand as far as an investment structure is concerned. If you have to pick stocks, or if you have to pick countries. So that's exactly where we stand at this point in time.
So as an investor, because Kenneth, there's so much flux in the world right now. As an investor, what do you take as markers to dictate your investment strategy? You've already had a correction in India, you're sitting on cash, waiting for the opportunity, but now looking at what's happening since April 2nd, you're wondering whether this is the opportunity or not. I mean, do you have, like you rightly said in your note as well, I mean, should you be discussing valuations and stock prices? Should that be the only benchmark right now to try and figure out where to park that money?
I think we'll be the strongest part, we'll be an economy with having a strongest growth footprint across most other countries in the region. So if you have to take that narrative out, valuations and stock prices at this point in time, you take a backseat. You just become an asset allocation country.
Okay. So to keep it very simple, avoid exporters and buy companies which have a domestic and they're inward looking.
Reverse of that.
No, but you'll have to avoid exporters. No, if I'm exporting to US, if US demand comes down, that means my business will go down.
So I
Maybe I'm
at the
getting it
start,
wrong.
No, at the start, I did mention that we are a very tiny part of the world economy.
Okay.
Right. So if US is a large importer and if they're sitting with inventory levels, so assuming that they're an economy of $27 trillion, approximately 20% or 30% of their entire balance sheet is sitting in inventory. Okay, that's about $9 trillion.
Yes.
Okay, and 50% of that is up for grabs for everyone else.
Okay, fair point. That's a great point. You know, with Kenneth Aisha, I
Okay.
always say the number is 6. He says, no, it's 9. Look at the other way around.
So whichever way you look at it, the opportunity subset is large out there. So the context is the opportunity size has not changed. That opportunity size is not growing. But in that opportunity size, you've got countries with a lot of countries are going to lose out in that.
So where does the per capita logic come in then? Because if the opportunity size is shifting from one country to other country, the US per capita is north of $20,000.
$60,000.
$60,000, right? China is about $25,000. India is about $3,500. So while the consumption may migrate, it will shift from one place to another place. If the per capita of other countries is much lower than US, then what happens to the absolute demand?
I mean, not next 2 years, don't expect any radical shifts.
Okay. So if I am an investor, should I be using this as a time to buy into companies which would benefit because of this shift? And if yes, where are those spots and which are those sectors and companies which would benefit?
So any Indian company, any company, okay, who's on the right side of the trade, feeding into the US's cash pool. Like I said, the inventory liquidations creates a cash pool and no one's resupplying that money. I think that's where you have to pick the transactions. Okay, any non-discretionary consumption in the US will do extremely well.
Non-discretionary consumption, okay.
Okay, any industry which is working with efficiency of the entire corporate structure in the US, I mean IT is one of them, that should continue to do well. If it's not doing well in the last 1 year, I think it might change trajectory in the next 6-7 months. Okay, so that's essentially where we are. And in a slightly more medium term, I think the rest of the world is also going to go for a capex cycle. Right now, for the next 1 year, till all of these, till policy clarity is not there, there's not going to be too much of a capex cycle. Capex is dead across the world.
So you said earlier that India is going to be a beneficiary of capital allocation or reallocation in the current scenario. But that capital, assuming that you're talking about FPI, FI money, that's only going to change the obvious names, right? The large cap banks and maybe IT.
Let's wait and see. I have a slightly different opinion right now.
Which is?
No, it will be much more broader.
Okay.
Okay, and one thing about foreign capital coming into the country, it is also reasonably sensitive on what pricing that they pay for these companies, and businesses. So we'll have to wait, watch, and see how the cycle actually moves on. But I mean, I don't think we need to worry too much about the slowdown that's happening across the world. We will continue to maintain an element of growth, may not be as high as we thought it would be, and we could continue to plod along. The sectors will be very, very traditional in nature. I think we've seen a slowdown happen in the domestic economy for the last 6 months, 6-9 months, 3 quarters. I think that will continue to be there. So if you ask me, between investing in the domestic economy or investing in businesses that are going out for growth, you will still have a growth, a complex of companies which will grow, which have to still establish global market shares, because that is the cash pile and that is the pool of opportunity that is there. In the domestic market, if you're going, if you're looking at domestic-led businesses, you have to be very sensitive about valuations, because growth might be capped for a while.
You're talking India here.
About India. Companies addressing the domestic market, there's no point in building up a growth multiple in businesses that are just addressing the Indian markets.
Your thoughts are very different. I mean,
yeah, I was just going to come to that, because what does it leave you with? Because if you're talking about the domestic linked sectors, if you're saying capex is going to slow down, economy is going to take a stall, I mean, What's left there?
So in the domestic environment, I think we financials after a long time have come to valuations where you could break up and make an argument for some of them. Okay, but that's a nice place to be in, nice place to hide. Um, uh, tech, metals or primary base metals, again a nice place to hide because the intermediate intermediate products that are there have got valuation, sorry, I won't say valuation, have got pricing power, so profitability will be reasonably strong. Okay, and volume growth will be also a single digit. Those are two sectors that are domestic that could be okay. A lot of consumer businesses have corrected very, very sharply. Okay, and there you have to go stock picking. It's not a growth market at all. So the markets will narrow down. Will it be as finite as it was in 2018-19? I don't think so. The market, if you're addressing domestic companies, will narrow down. But any part of the world, any company, and this is what our portfolio reflects. Any part of an industry which is targeting inventory restocking in the West. Okay, we should be. I think that's where the growth metric lies. It's difficult to calibrate what kind of growth is there, if there's growth at all. But I sense that over the next quarter or 2 quarters, which is as soon as that, we could see a material difference in businesses there.
So other than IT services, what could be it?
We look pharmaceuticals. So look at non-discretionary spending in a world economy which is slowing down, and I think you will get most of those answers out there. Pharma, a lot of services, okay, and a lot of services including IT. And if you can address some part of the textile value chain out there, not all of it, textile value chain, non-discretionary, I think that's some ideation out there.
You know, we were reading an ad yesterday from a company which is claiming that they would have the largest garment factory in the world in India. Kitex, I think. We verified with the company. I could never thought that in India a factory could be created which could be larger than these Chinese
25,000 employees,
25
right? Or something
employees
like that.
they are looking at hiring. So yeah, I mean, magic is happening. I mean, look at the iPhones which have been made here. Magic is happening. So Kenneth, I just want to spend a minute on IT. Now, the logic given by most of the IT naysayers is, guys, they get a lot of business from BFSI. BFSI is a function of government spending. US federal is going to be going easy on government spending, which means directly or indirectly BFSI takes a hit. Second logic, AI, a real deal. You don't know which end of the candle is burning for them. But right now everyone is saying that both the ends of the candle is burning, which is demand as well as disruption. How would you defend that?
Yeah, so those are what's questioning the growth of this entire business, right? Everyone's questioning the growth of this entire businesses, and if you look at all of them, they're down almost 30-35%. And this quarter should be like a nail in the coffin, so as to say.
Totally.
So now they get extremely valuable because of all of this that's happening out there. Okay, that's essentially what price point that you've been looking for if you wanted to buy a fairly mature business with a low single digit growth, Okay,
and
mature
dividend
business
yield.
at
And
a
buyback.
certain
Buybacks.
valuation. At a certain valuation, right?
Are valuations attractive in large top 4-5 IT names now?
Yeah, I think you should only go there. From our context, we've always avoided, from a process point of view, buying companies at an extraordinary valuation, irrespective of the growth metric. So if you can get a nice, mature, if I can even call it a fuddy-duddy business out there, okay, at a great price, with a valuation yield, with a dividend yield, you're actually getting paid to hold that business. Now, from a stock perspective, you've got to figure out as to how are they encountering all these challenges that are there. Okay, and I think there are enough and more of those companies who understand and are building an ecosystem into the new opportunities that are there. So you look at the opportunity that's getting created and build an opportunity into that. So you're moving away from your traditional domain of just services and to do something much more wider.
There are two trends which everybody in a sense is trying to understand what could be the impact of tariff. One, where commodity prices would move. right now the market is telling you that demand will be lower. Crude is down, copper is down, everything which has got to do with commodities is down. Second is which way inflation would move. So one side, half the Janta is talking about demand drop, half the Janta is talking about inflation coming back. Now that will be a very large interplay. One will be right, one will be wrong.
Both are right.
They both are right. So we're heading towards stagflation.
So the US has got inflation driven by tariffs.
Okay.
The rest of the world is holding inventory,
Okay.
which was supposed to be shipped with the US, and you have deflation.
So simple.
It is. I mean, it's a transfer of inventory from one country to the other.
So
one
what
is
should
getting
Indian
the
investors
cash
buy?
and one is getting all the
So
inventory.
what should Indian investors buy? Do you buy commodity consumers? Because if commodity prices they come down, which is what they have, so suddenly you will see margin expansion, demand coming back, lowering of prices by cement companies, car companies, oil companies. Is that the trade?
No, Nikunj, you got to build a portfolio for an economy which is slowing down, for a global economy which is slowing down.
Okay.
Okay, in a global economy which is slowing down. Now, typically look at what happened in India post-COVID.
Yes,
What
economy
happened?
slowed down.
And what happened to corporate balance sheets?
It became better. Why? Because they were able to retire their debt eventually.
What will happen to the rest of the world?
It'll get better. I should call you Professor Kenneth from today.
No. I mean, we've got a case where we looked at a very small environment that was there, which is India, and you saw all of that came through. And today, all corporate analysts are sitting here saying, analysts are saying that we are the best debt equity ever, and no corporate is willing to invest. Why is no corporate willing to invest? Because everyone knows that with the scale of manufacturing that China has, nobody knows as to what the pricing will be.
Yes.
And no one's going to invest in uncertainty.
Okay. So if the starting
But
point.
just to make a point here, there's a difference between that COVID time. Money was so cheap that you could raise so much cash, and I think one of the first few fundraisers was by Bajaj Finance, if I'm mistaken.
Bajaj Finance raised and Aditya Birla Capital
So
came
many
in. The
of
word
them,
investment ka Mahakumbh
it was available cheap.
Yeah. So Kenneth, now that
But if there's no growth, why would anyone need the money?
so Kenneth, one interesting sector.
So that's what. Sitting here right now, can you really envisage that growth? COVID was like a low point. You didn't know whether you're going to survive, whether you're going to be alive after this or not.
Yeah, but don't look for growth. How do you build a portfolio into a market which is not growing?
So what does well when there is no growth in the world? They say defensives, and that is where you're saying buy IT, buy pharma. I mean, to put it very simple, right?
Defensive is when a company is self-sustaining with no access to external capital, has enough of cash to manage its next 2-3 years of operation. Pick and choose an industry that you want. You've got all of
Finally,
India.
I'm getting it, Kenneth. Finally, I'm getting it.
You
Aligning with
build
your
all
thoughts.
of India.
Finally, I'm getting it. See, that's what happens every time. We must interact much more, at least in the studio.
Anytime.
Yeah. So before we wrap, let's just
We
understand.
get to exercise our minds in a very different way.
No, it's a very different thought, Aisha. I mean, just think about it that if US has to bring costs down, which is what Trump administration is committed to, they will not let healthcare costs go up. So pharma should not be taxed.
He has to bring the supply chain home.
Yeah.
And that's going to take a lot of time.
Yes, you got a window of opportunity. How much can you build on that window of opportunity? And there are, if you build on that value chain, there are enormous amount of opportunities that are sitting out there.
So, Kenneth, other fear is that what if China starts dumping? They have excess capacity in everything: chemical, solar, steel, pharma, base chemical, specialty chemical. They are left with abundant capacity. Their biggest buyer is no longer their best friend. What happens to all the excess capacity? Will it come our way? Will it impact Indian companies?
So, Nikunj, what happened to Russian oil?
Russian oil we bought at cheap because the world was not buying.
And what happened to it after that? How much did we export out of it?
Nothing actually.
India is the next exporter of refined products.
Okay.
Okay. So, what happens if you have cheap raw materials in the world marketplace?
We will have margin expansion and we will be exporter of the world.
No. I would see all of this is scenario building.
Yeah,
we will never have answers till it happens, right? So we'll have to build out scenarios as to what has happened in history, where do all the pockets of opportunity have? How many of us can build portfolios and not say the word growth, okay, because that doesn't exist, and work with those models. I think there are enough and more of them even sitting in India with no growth that can actually expand volumes.
I don't know how to wrap this interview. Thank you, Professor Kenneth. Thank you, Sir Kenneth.
Professor.
Thank you, Kenneth.
After Professor Das yesterday, now it's Professor Andrade.
So nice to talk to you. I mean, we've just discussed
Thank
something
you
which is
very
very
much.
different,
Thank you.
very
Yeah.
refreshing, very original. And I hope it is
A
helping our
different way
viewers.
of looking at things.
Yeah, maybe that's the right way. I mean,
Yeah.
that's what investing is.
And
Yeah,
Glass
there's no
half full.
right or wrong. It's just your view.
I just like to end with saying don't be bearish on the cycle. It's not so bad. It's just a market which has slowed down. Give it a year, year and a half. You still might get your stock prices right.
First rule of Itina, we always bullish because rise with India.
Okay, on that
Super.
note, we're going to take that much deserved break.
If you like this video, then like, share and subscribe to ET Now.